This bar chart displays a mathematical contradiction. On the left is the original principal debt owed by Vijay Mallya's Kingfisher Airlines, 6,203 crore rupees. On the right is the amount the Indian government has actually recovered from him as of early 2025, over 14,131 crore rupees. Mallya has taken to social media and high-profile podcasts with a seemingly logical argument. Since the recovered assets are more than double the original money he borrowed, his bankruptcy proceedings in the UK should be immediately annulled. The consortium of lenders holds a very different position. According to their ledgers, despite restoring over 14,000 crore rupees to the public banking sector, Mallya still owes a staggering gap of nearly 7,000 crore rupees. While the public remembers Mallya as the flamboyant king of good times, he holds a more severe legal distinction. He is the first person in Indian history to be designated a fugitive economic offender. This missing 7,000 crore rupees represents the compounding result of an individual who successfully weaponized the blind spots of three distinct systems: corporate law, public banking, and international extradition. The first failure occurred in corporate governance. In 2005, Mallya launched Kingfisher Airlines. He aggressively positioned it as a premium carrier to match his personal brand, but the service was too expensive to maintain. For 8 consecutive years, the airline failed to record a single profitable quarter. To find profit, the airline needed to fly lucrative international routes. But Indian aviation law had a strict constraint known as the 520 rule. No domestic carrier could fly internationally until they had completed 5 continuous years of domestic operations and built a fleet of at least 20 aircraft. Mallya found a 550 crore rupee loophole. In 2007, Kingfisher acquired a struggling low-cost carrier named Air Deccan. By buying the smaller airline, Kingfisher inherited its operational history, allowing them to instantly bypass the 5-year waiting period. Investigators from the Serious Fraud Investigation Office later discovered the merger was a financial disaster hidden behind compromised corporate ethics. Kingfisher failed to disclose a 30 crore non-compete fee paid to Air Deccan's founder, and created internal departments specifically structured to avoid capital gains tax. Immediately following the takeover, the airline reported a net loss of 934 crore rupees. Mallya prioritized regulatory workarounds and brand prestige over fundamental business logic. By fusing a high-luxury brand with a failing low-cost model, he built a corporate structure destined to collapse under its own weight. By 2010, the global financial crisis and spiking aviation fuel prices pushed Kingfisher into a severe liquidity trap. The company was drowning, owing $1.3 billion to a consortium of 17 different banks. The standard protocol for a failing company with no profitable history is rigorous restructuring or immediate liquidation. The consortium, led by the State Bank of India, chose a third option. They initiated a debt recast package, essentially artificially restructuring the loans to delay declaring the airline a non-performing asset. This scale illustrates the fatal flaw in that agreement. To secure the restructured debt, the banks accepted an intangible asset as primary collateral, the Kingfisher brand and trademarks. Based on a highly questionable internal assessment, this glowing logo was valued at 4,111 crore rupees, allowing the airline to borrow massively against phantom capital. The lenders accepted inflated, intangible collateral to avoid claiming immediate losses on their balance sheets. That decision made the public banking sector highly complicit in the fallout when the airline inevitably defaulted. The Enforcement Directorate's 5,300-page charge sheet alleges that the collapse of Kingfisher Airlines was a deliberate criminal conspiracy to launder money. This network map traces the alleged flow of the laundered money. The primary extraction method was over-invoicing aircraft lease rentals. Between 2008 and 2012, Kingfisher inflated the costs of its leases, quietly siphoning 3,432 crore rupees out of the company under the guise of legitimate operational expenses. Once the money left the airline, it filtered through a web of shell companies spanning 7 countries. These entities had no real business activity. They existed solely to obscure the money trail, with hundreds of crores diverted directly into Mallya's personal ventures, including the Force India Formula One team. The final integration phase converted those loan proceeds into hard personal assets. Mallya acquired a 250 crore rupee estate in France, an 80 crore rupee property in the UK, and transferred $40 million to his children through Swiss bank accounts. While loan capital was being converted into European luxury real estate, Kingfisher employees back in India went completely unpaid for 15 consecutive months, right up until regulators suspended the airline's license. Mallya used the heavy, legitimate operational mechanics of a regulated civil aviation industry as a front. It allowed him to run a highly efficient, borderless shadow economy directly underneath the noses of his lenders. In March 2016, as the consortium of banks finally moved to restrain his travel, Mallya boarded a flight to the United Kingdom. His evasion was so disruptive that the Indian government was forced to draft the 2018 Fugitive Economic Offenders Act, a law designed specifically to strip legal rights and confiscate global assets from individuals who flee the country's jurisdiction. Despite UK courts finding clear evidence of fraud and ordering his extradition in 2018, his actual return is currently stalled by a confidential legal matter. Mallya is actively pursuing political asylum, arguing that Indian holding facilities, like Mumbai's Arthur Road Jail, violate international human rights and humanitarian standards. The Indian judiciary has drawn a hard line. In February 2026, the Bombay High Court issued a strict ultimatum, ruling that an individual who actively evades domestic legal process cannot seek equitable relief from that exact same system. Until he physically submits to the jurisdiction of Indian courts, they will not hear his appeals. The extradition trap relies on a geopolitical loophole. Mallya is weaponizing the humanitarian laws of the UK to permanently delay facing India's financial laws. This graph brings us back to the mathematical paradox from the very beginning. The reason the Indian government can recover 14,000 crore rupees and still be nearly 7,000 crore short comes down to one legally mandated variable, an 11.5% compound interest rate. Because Mallya has successfully dragged the legal battles out for a decade across multiple international borders, the interest and penal charges have continually accumulated. That original 6,203 crore loan has artificially inflated to a total liability of 17,781 crore rupees. The math constantly outpaces the government's recovery efforts. In an era of highly mobile, borderless capital flight, justice delayed by international bureaucracy translates to a very real, mathematically compounding burden on the public.